Morning, good morning. So you're there, we're here. It can only mean one thing. It's another live and interactive advice show beamed to you from the Tower of Power atop the Simply Biz studios here in London. My name's Dan Russell and you are very, very welcome. And as ever, we have got a crackerjack full programme for you between now and about 1:30 this afternoon. So strap in and get ready for the long haul. As ever, you're in charge of this show. You dictate where this goes. So what have we got lined up for you today so far? Later on, we're going to be looking at the defined benefit pension sector. We're going to be bringing in different suppliers and thought leaders from across that area to tell you all about what is and isn't happening with defined benefit pension transfers. We're going to be looking specifically at income investing for about half an hour from 11 o'clock onwards. And we've even got Ken Davey himself, the chairman of the Simply Biz Group, coming in to talk about all things about the advisory market, regulation, pensions and where things are going next and the future of financial advice. He was going to be having that debate with Sir Steve Webb from Royal London, the former pensions minister. Sadly, Steve can't make it today. However, you'll have to wait and see what we replace him with in the chair. But in the debate, we're going to be replacing him with you. Because remember, you're in charge of the content of these sessions. So get those typing fingers out, whichever device you are watching us on, whichever room in the house or the office you're watching us from, even the smallest one, we want you typing away and sending those questions in. So get those typing fingers ready, and we're going to start off with our usual overview of the entire investment marketplace, the investment landscape and what is happening. And as ever, I'd like the kindly ginger umpa-lumpa that I am, have I got a little something for you in terms of the team that we've pulled together. We've got none other than Paul Flood from Newton Fund Managers, part of BNY Mellon. We've got James Isley from JP Morgan. We've got Tom Wells from Aviva Investors, and we've got a man whose red braces have even been known to permeate black and white photographs. It's Justin Urquhart-Stewart. Gents, let's start off by, before we get inundated with questions from the advisors, let's have a think. What's driving the market activity out there at the moment? What are the key market drivers that you've got your eyes on when you sit round with your abacus in your team rooms and work out where clients' hard-earned money should be invested? James, what's driving your thoughts at the moment?
I mean, clearly, I think the debate at the moment is where interest rates are going. You know, we've been talking about rising interest rates for probably, 6 years. We've all thought there's going to be an interest rate rise 6-9 months out, and it's always been pushed back. But I think we're getting closer to that point in time when not just in the US, but not just in the UK, we are starting to see that interest rate environment come a little bit closer. I think it's sort of pretty much nailed on. The US will be raising rates in December if you look at the forecast. So I think that's going to be a big change going forward for a lot of asset classes, not just bonds, but equities as well. Okay. So that's what we're thinking about in terms of our outlook for UK and how that might impact, the wider picture.
Tell him he's talking rubbish, Tom.
So I know I do think actually the consequence of interest rates is interesting, but I think probably more significant from our perspective is what you're seeing about central bank balance sheets. So just to give some numbers for the audience, 2008 central bank balance sheets were $4 trillion. Today they're $14 trillion. Bank of Japan owns about 60% of its local ETF market. And we've seen last week the Fed, it's announcing it's going to start shrinking its balance sheet. So what's that going to do to asset prices? And that, for us, I think is the most significant thing at the moment.
Okay. Paul, what are your thoughts?
Yeah, I would tend to agree that the real concern is the pace of that asset unwind, and the idea that QE was meant to help the economy, and unwinding it is not meant to affect the economy. I think is there's two sides of the same coin there, so we do need to be careful of that. But the Fed has been very prescriptive about its interest rate policy and its QE. So if things do start to unwind too quickly, and bond investors pull away from the bond market, I think they will slow that pace of growth. But as Tom said, $14 trillion worth of central bank bonds to be sold into the marketplace. I don't imagine anybody would want to stand in front of that freight train. So that would be my concern, which is why we stay away from bond markets today. Not only because of that, but also the returns available in bond markets are paltry relative to any other time in history. It only takes a 25 basis point move in the yield curve to wipe out your total returns in investment grade bonds over a 12-month period. So I believe there are much better assets to be looking for which have low sensitivity to the economic cycle, and much higher returns than you can achieve in bond markets.
So just to add, one thing I think was also is there are ways to make money in this type of environment. I mean, for us, we talk about the strengthening of central bank balance sheets and potentially curve steepening and things like that. So there are certain asset classes, and for us, it's things like European banks, banking stocks, which can actually benefit from potentially steepening curves, potentially this unwind of central bank balance sheets. So it's not all bad news. It's really kind of the important factor for clients.
I think it's interesting, though, if you look just the overall market, I don't disagree with the points you're making there, absolutely valid as to what's happening, but there's this air of complacency at the moment in that we've had a series of things occurring, and nothing is moving this market in terms of any other time you'd expect to have seen a lot more volatility occurring. Now, we enter the season of storms, and not just meteorological ones. So I suspect we're going to be seeing some more volatility over the next few weeks and months, which is actually a rather good opportunity for us all. But it is astonishing, whether it's some of the political issues, geopolitical issues, economic issues, that really haven't actually shaken the market as yet. So maybe these are the interest rates. We had the Governor of the Bank of England on Radio 4 this morning, all but saying rates are now going up. So that is going to be a serious concern because there's QE pushed those asset prices up, and unless they're really, really careful, it's going to actually, that'll be, maybe that is the supporting, the last supporting block underneath it all.
But I think the fact that we're talking about a tightening environment, it's kind of a normalisation of policy. I mean, what's been in place since 2008 is a kind of emergency stimulus. The economies have grown for many, many years and decades without all this emergency stimulus. So we're going back, hopefully, to an environment which is more normal. The economy's grown naturally. They don't need all this stimulus.
Rates are going up.
As long as we manage
rates
that
going up in
transition.
the States is good news. It is that first sign the cycle is coming up. And of course, I think what Yellen's looking at is 18 months ahead, when that economy does start slowing down. That gives her the opportunity, assuming she's still there, to be able to start cutting rates again.
I think just back to Justin's point there about the sort of this, what's the consequence of the central bank withdrawal and stuff. I don't think it's the last factor holding up the markets. I think what it does mean, from our perspective as multi-asset fund managers, is we've got to work harder. Previously, post-crisis, you could have bought any asset and it's gone up. I think now you've really got to start working harder, differentiating between regions, differentiating between sectors. So that's for us.
Arguably, as multi-asset investors, it creates more opportunities for us than there has been historically. But multi-asset investing is as much about what you don't own as what you do own. So if you don't like bonds, then just don't own them. Go and find somewhere else in some other part of the globe, in some other asset class to invest in. And remember, as rates go up, of course, that creates good opportunities in that the bonds that are maturing, you get to reinvest at higher interest rates. So it's good for savers to have that kind of environment. The impact on the economy is the next question we have to answer.
It must be one of the most trailed interest rate times. I mean, I don't think it's going to come as a shock to anybody, hopefully, that interest rates are going to be going up on a reasonably short time horizon, which, unlike some previous tightening cycles we've seen.
Well, when you think about it, the Federal Reserve has been incredibly bad at forecasting the interest rate path over the past 5 years. Now, given that they control the interest rate, they're not very good at the forecasting part of it.
But one of the other issues as multi-asset managers we have to look at is, remember last time we went through a crisis in 2008, there we actually saw, we'd all thought the correlations, things weren't correlated, everything got hit. So if we're heading for another event at some stage, have we learnt from that to make sure that we're not going to see the same thing again? Or have we diversified enough into other areas, really uncorrelated ones? And I take a great comfort. I talked to the other managers around, and they've looked at many more areas which are tradable, liquid, and are not correlated, but of course as yet untested. I think it's going to be fascinating to see how that pans out.
I would tend to agree with that. I mean, you don't buy investments just for the diversification purposes. If you know they're going to give you a negative return, but they offer diversification, there's no point in holding them. But it's also, this is different from the financial crisis. The banks have been fixed. The capital ratios are much higher. So I don't think we're going to get the breakdown of diversification that we saw in 2008, but we certainly have to be careful about relying on historical correlations because this is a very different environment than any other time in financial history.
Cool, I'm intrigued. So you're obviously slightly bearish or extremely bearish on bonds. I was wondering whether you're going to differentiate between any bonds, like maybe for us, for instance, we like Australian government bonds or US treasuries, US tips. Or is it all bonds together? And therefore, if it is all bonds together, when you run a multi-asset portfolio, what do you look for in terms of defensive assets?
Yeah, I mean, it's a very good question. So the way we think about this is, what is it that government bonds do for you in a portfolio? Well, they go up when equity markets go down. It's a diversification purpose of them. If everything else has a risk premium on it, then there's no place in a portfolio for the lowest returning asset. So what is it that government bonds have? Well, a low sensitivity to the economic cycle. So we're trying to find assets that have a low sensitivity in terms of their cash flows to the economic cycle, things like infrastructure, PFI-based assets, renewable energy assets, where 40 to 50% of the revenue streams come from government subsidies, yet you get 6 times the return on a government bond.
I guess my pushback to that, and to come back to Justin's point actually, was, for instance, I look after daily price, daily liquid funds. So how do you get the liquidity in sort of infrastructure? It sounds nice, and yes, it's got good cash flows, but it sounds pretty illiquid, or is it not?
Well, I mean, if you look at just the UK alone, the UK infrastructure market cap of UK infrastructure companies is 13 billion, so it's a fairly liquid space. Globally, it's much bigger than that. So we look at things like IRB in India, which is the Indian toll roads. It's slightly more economically sensitive, granted, but the Indian economy is very differentiated from the global economy. It's a very internal economy, so it's very domestic led. So that offers diversification purposes in itself. And then when you think about the vast quantity of renewable energy assets that are around the globe, there's huge quantities of this. We don't turn the lights off or turn the heating off just because we're going through a recession. So they're very low sensitivity to the economic cycle. Now you have to think about that in a portfolio construction point of view as well, because what are you adding in terms of risk characteristics? Well, duration, because these are long life projects, so similar to a bond. Inflation, they're generally inflation linked. And then you have exposure to the power price, which is linked to the oil and gas price. So you have to be aware about the risk characteristics and the interplay between different asset classes, not just on individual asset classes.
Yeah, this whole area has changed radically in the past 10 years as well. You've got much more choice than you would have had, and certainly if you're looking at some of the sustainable areas. There's not so much in the UK, but actually it's much more we've seen in the US. And that does give us, I think, a very good diversification. And it's interesting to compare the portfolios, the range of assets we were looking at 10 years ago to where we all got now. We've got a much broader choice, and broader choice with liquidity, which is going to be crucial.
I can't see. Much I'd love to agree. I can't.
No, don't. Please don't.
So, because I do think there are opportunities in potentially these areas, but you talk about the factors and the risk factors associated with some of these investments. You mentioned inflation and duration, but liquidity has to be one of them. We saw what happened. You mentioned 2008. We saw what happened when investors blindly forgot. They thought they were buying something liquid, and then they turned out it wasn't. And I think when we talk about central banks' activity and what have they done, one of the biggest factors they've done, not only have they flattened yield curves, but by bringing down the risk-free rate, they've pushed out natural investors further into asset classes they would not ordinarily buy in search of income. So obviously you're talking about income later.
Arguably high-yield bonds.
In high-yield bonds.
Which is a specialist asset class.
Medium yield is what we prefer to call them at work.
I would suggest that's low return and high risk rather than, whereas some of the things that we've been talking about are actually very low risk in terms of their business models, unlike high-yield bonds, which are very sensitive to the economic cycle.
So I'm not just pushing back on the investment merits, but I think one has to remember the liquidity one's offering to clients. I think we should learn from their ways.
Some of these are tradable. When you get some of the ones I've come across where people have been looking at things like aircraft leasing, which is a perfectly valid investment, but that's not liquid, and it's a long-term play. So that for us would not be suitable coming in.
Sensitive to the economic cycle.
Absolutely. So that wouldn't fit in our book on that.
But everybody seems to be talking quite negatively about the economy. I mean, is that the general feel?
I wouldn't say
for
that.
us, when we look around, we can look at a lot of the economic data. It doesn't seem like we're close to the end of this. Well,
it makes a rotten headline, doesn't it? Global economy doing quite well.
Yeah, because it doesn't sell papers.
I mean, you're very much right, Jane. I mean, I think global growth is close to 4%. And I mean, look at Europe, 2.2.
But then under that scenario, why would you own bonds? I mean, so we're talking about replacing bonds with something else because of the low returns that are available.
Why don't you go to? I mean, obviously, I'm an equity investor. So I would push equities, but
of course,
for me, in
we
this
can't have
environment,
100% in equities.
Yeah. Agreed.
I think that's a very good point you bring up there, Paul. Why would you own bonds? And for us, we don't look at bonds. We look at growth assets and defensive assets. But we do own some defensive assets because in our central view of the world, we are positive on growth. we're overweight risk, but we're being selective between regions and sectors. But what if we're wrong? We are human, we're
Well, what's
fallible.
your definition of a defensive asset in that?
Exactly, so you have to, that's, for us, it comes down to a couple of things. We do look at US Treasuries because they are super liquid. We do like US Treasury inflation protected securities because of the inflation protection. We do like Australian government bonds. There are certain areas in the globe where we think they do have defensive qualities. Conversely, UK gilts, for instance, European government bonds, wholeheartedly agree with you there in terms of the valuations and how they don't have the defensive qualities. But I do think they have a role within a multi-asset portfolio.
So there's other things sorry.
Yeah.
The other issues, particularly with regard to inflation, where, go back, if you wanted some inflation protection, you'd have your linkers and things like that. Now we can go a stage further. We can actually just take the inflation strip. We don't need the bond part of it. 10 years ago, we couldn't do that. So again, we can actually hone these down and be, I think, smarter than we were with it. So I think that's quite exciting things. Also, you're seeing now more conscious awareness of actually how to try and manage the currency and currency hedging. Over the past year, that's been really important if you're a sterling investor. And this is something that often advisors and clients aren't particularly aware of. And yet it's something that actually institutional investors have been doing for some time. Coming into the multi-asset market, I think that's actually much more interesting now.
And so just to take it back to 2008 on that argument around these assets being illiquid, if you look at the PFI-based infrastructure in 2008, it was up 5% for the financial year in 2008. So the idea that these are illiquid assets and can't give you positive returns in periods of crisis, I mean, it's very stark to sit here and say something, one of these assets might be illiquid, but actually it gave you a positive return in the financial crisis. So I would argue the reason it gave you a positive return was because of its low sensitivity to the economic cycle, and also when people saw how attractive the returns profile was relative to everything else that was going on in the marketplace, people fled to those safe haven assets.
One other defensive one, which I suppose we should mention, I personally dislike it intensely, is gold. Everyone gets terribly excited, and you're going to get harassed by gold bugs the entire time who will tell you it's been fantastic value since Cleopatra was alive, which is a fairly fatuous statement. But nonetheless, this year that's been a pretty good return. But this is having an asset which gives you no yield whatsoever. But is there a place for that in the portfolio? And over the past couple of years, actually, there has been a place for it.
I mean, I do agree with Justin in terms of, I think, I have no desire for gold. I think it's a very difficult asset class to value, and you talk about cash flows and things. There's nothing, obviously, as you say, Justin, associated with gold and how you assign value to it. So, from our perspective, when we look for defensive asset classes, it just doesn't feel like it should have a role in a multi-asset portfolio, despite some gold bugs out there who may want it.
I mean, I would argue slightly differently there.
If
this 14 trillion that we're trying to unwind on central banks, I think it'd be incredibly difficult for them to do that. I think they'll start to unwind it. The market will get nervous about it. That will lead them to stop unwinding it, and when the next recession comes, they will then print a whole load more of money. This isn't capitalism as we know it. This is the socialisation of the capitalist system. If this isn't unwound, I can see an entirely plausible reason why gold could double from this point.
So just to understand, I always think it's interesting to understand people's investment thesis behind it then. So you own gold as an inflation protection? Is that the idea?
I mean, the reason people own gold is because there's a lack of trust in the financial system and governments around the world. That's why gold historically has always held its value in real terms.
It does sound, and I'm not going to try and assert whether there's any valuation to bitcoins and things like that, but it's obviously a similar concept behind the digital gold currency, I guess. Yeah, I mean, I think gold does have a role, and we look in the 2008 crisis in terms of panic-driven periods. It does play a role, but a lot of people talk about deflation, talk about inflation, and I always think, coming back to Justin's point, there are probably better ways, more sophisticated ways to protect a portfolio that isn't based upon an asset class which pays nothing. I have no idea whether it should be $1,300, $1,400, or $600. How do you assign a value to it?
It has no purpose. Well, for me, when I look at it, you dig it up, it costs a lot of money. You store it, you guard it, it costs a lot of money. And what does it do? I mean, that's, what's Warren Buffett's argument. So you spend a lot of money digging it out, and then you bury it underground, and he can't understand gold, so I'm not going to even pretend to understand gold. I just feel that the tone of the debate is quite negative, though. We're all talking about protection, downside risk, finding uncorrelated assets. I mean, it seems to be, we're worried more about losing money than the opportunity to actually, grow the money for our clients and expand it.
Rule 1 of investing is don't lose the sodding stuff. Rule 2, refer to Rule 1. But you're quite right. Yes, we have to, and one of the messages we have to put out, I think, very clearly is longer term investing actually is making it grow over a significant period of time, making sure you've actually got that money compounding for the benefit of the clients. And we're not here to just try and gamble it, and we're not going to be coming out of it. We have to be in this market in some form or other. But it's just a matter of judgment, just how much risk we want to take off the table. At the moment, we have been taking risk off the table, for the point I was saying earlier, in terms of this complacency. It just doesn't quite feel right at the moment. And I'd like to see a bit more volatility, so I could actually see how some of these things are behaving.
From an outlook perspective, James was saying, and we are overweight risk, so we are positive.
Yeah.
But I think, from my perspective as a fund manager, I can have the central view, it can be positive overweight risk, and then I like to spend a lot of my time debating with people like Paul, thinking about what if I'm wrong? How do you protect yourself? And that's really, I think, why a lot of times concentrated on the other side of the coin. But as I say, we believe that you are being rewarded as an investor today to be invested.
James, I've got a question from an advisor who's channeling your thoughts here, and it's I guess it's to be put to Justin. John Milburn asks, thank you, John, well done. Why is Justin so negative? He loves the word volatility. Now, we mentioned at the beginning, actually, and this is something I've been meaning to pick up, as you've been debating away, there is a lot of talk about these defensive assets, yet it's been such a very, very calm sea out there in terms of volatility, hasn't it? Is there a fundamental expectation of change on that?
We are in a strange world, aren't we? Because if you just think about it, we were talking about the fact that interest rates haven't moved. There's no economics book which tells you how to come out of QE. So we're in uncharted territory. So you can understand why people are quite rightly nervous with clients' money. We don't want to take a huge amount of risk, but at the same time, we want to be able to make sure we're still growing it. So I think it's very healthy that we're actually sitting there, walking nervously across the ice and listening for cracks. Now, at the moment, the economies are all doing very nicely indeed. They almost look as though they're acting in concert together. They're not, but it almost seems slightly too good to be true at the moment. But that doesn't mean you sell out. Yeah. There's nothing wrong with taking some profit, though.
Coming back to the volatility thing, I do think it's interesting. So we spend a lot of time looking at volatility, and I think the numbers suggest it's about one standard deviation below average. So we are in a low vol environment, and some complacency conversations, or whatever you want to think. Partly, a couple of things I think it's worth noting. One, we can stay in a low volatility environment for a long period of time. So I mean, that's the thing. You look back historically, it can persist. For us, a big part of the reason why we are in a low vol environment comes back to that central bank thing, back to the way they've expanded their balance sheets and brought and crushed volatility across the board using QE. But I think Paul and I share the same view in terms of valuations within credit, because in a low vol environment, you want to be overweight credit, you want to be overweight high yield, you want to be overweight investment grade credit because you get paid for the carry. But it is an expensive area. So from us, from a positioning perspective, we may like equities, but things like credit, we're sort of certainly underweight.
I'll give you some perspective. When I started, when I think about valuation relatively straightforward as an equity investor, I started in the city in 1990. Back then, gilts yielded 10, 12%. Cash yielded 10, 12, 15% as we came out of ERM. Bonds up there, and yet equities then yielded 4%. Yeah. Today, cash yields you 0, gilts yield you effectively 0, 1%, and equities, which are growing their income, yield you 4%. So, we can talk a lot about bonds. The fact is that bonds have re-rated. We're talking about the end of that tuning fork. If you want to see the big asset class that possibly is cheap in this whole environment, which hasn't re-rated over the last 30 years, it's clearly equities.
Well,
if you think about the long cycles of equities and bonds.
I mean, arguably you can call it a 4% dividend, but payout ratios from earnings have gone up. The percentage of cash flow that companies pay out from their earning streams has gone up quite dramatically over that period.
But arguably become less capital intensive with a more tech-based economy, a more service-based economy. It's not like the heavy industry.
Well, the margins are certainly higher, but one can argue that the cost of financing for companies has brought down increased their margins quite aggressively. The cost of capital's come down, and yet we're still. Well, they have re-rated when we look at on any cyclically adjusted basis.
If you look at the US, it's about in line. UK is 15%.
But on any 10-year Shiller P ratio, now we can argue about whether you would follow that, because obviously the 2009 earnings are about to fall out of that, and that will bring the valuation down. But any chart that I've seen, cyclically adjusted P ratios are very high, but arguably that's because bond yields are so low.
I mean, I have a big pushback on cyclically adjusted P's and Schiller ratios because, I mean, the long data series, and it comes back to James's point, sectorial changes, the counting system has even changed. So they're using some kind of historical long-term trend to use it as a valuation, saying the Schiller P is 25, and therefore we should definitely be de-risking our portfolios. I just don't think it's a very good measure.
I would argue it's a very good measure in terms of where you are in the cycle, in terms of where people's the optimism or negative sentiment is. Ultimately, it's all about relative value. It's all about what are the returns profile in one individual security or asset class, and what's the risk around that returns profile relative to other places I can invest. And I would argue that the bond market is the most stark one in terms of the low returns that are available on a prospective basis. So arguably it is better to be looking in other places. I'll come back to that argument that we are looking for returns. We are trying to invest our clients' money. And when I look around the world and look at some of the renewable energy, the PFI-based infrastructure, the economic infrastructure, we're looking at 7-8% IRRs, and that's in stark contrast to the returns that are available even in the high-yield bond market. So to us, from a risk-reward perspective, when you think about what is our role in the industry, it's to increase the real wealth of our clients. Investing in the bond markets, especially long-dated gilts, to me seems like a very low return profile for our clients, and that's an area I would like to avoid given the risk of rising interest rates.
Well, the area I particularly like, though, in equities is more to my own part of the world, is actually going back to the Far East. And there, the rise of the Oriental consumer, which is primarily led by my daughter. And you can see how radically, and it's over the past 5 years, and I don't mean just China, how you've seen such a material change of the middle class rising and middle class spending. It doesn't stop them all coming over here and go to Bicester Village and shipping it all back again. But nonetheless, it is a radical change. Now follow that line through, and that gives you a lovely equity story. It's a longer term one, yes, but that to me is a good story which people can follow, they can understand, and it gives us a range of choice of areas we can try and invest in. I think that's very positive.
I mean, population dynamics certainly there in many emerging markets. Debt to GDP ratios are much better. They haven't undergone unconventional monetary policy. So there's a lot of positive things to say about some of the emerging markets and Asian markets, I think, over the longer term.
Just the pure valuations. I mean, we like emerging markets, and it's interesting. Comforting? Well, I think it's comforting. Everyone around the table seems to as well.
Well, we need to break them up into different bits.
Yeah, I agree. But I mean, if we just look on a pure valuation perspective, they are trading on maybe a 20-30% discount to developed markets. So from us, like I say, we like risk, but you need to work harder, and you need to, from our perspective, invest in more value areas. So it is definitely emerging markets. I think you do have to, and come back to Justin's point, take certain views. But for instance, we like emerging markets. We also like emerging market small cap. So we go active, go through a fund, and it gives you scope to, it gives you exposure to the domestic growth story that Justin just outlined. And valuations are very good there.
Okay.
But that's where you do have to be careful of liquidity, though, because some of those markets are woefully thin.
Yeah. I think that's the thing with sizing with positions is very important. So as with all things, I think we learned from 2008. You have to be conscious of liquidity and size a position accordingly.
I've got a couple of questions where advisors are looking to delve into the specifics of some of the things that have been said. Dennis Tam's asking, what's the outlook of PFI infrastructure investments if Mr. Corbyn comes in? And I guess the question is, would you have some sort of hedge against that within a portfolio?
Yeah, I think, that's a very narrow focus on PFI in the UK. Let's remember PFI is a model that's been exported across the globe. Canada, Australia, the Chinese are now doing it. So certainly when we look at that space, we tend to be much more geographically diverse. What I would say in regard to the concerns in that question is that all of the contracts that we've seen in this space have very good contractual terms and under which the government can take these back into the private, the public sector. So they have to pay fair market value for the future cash flows. And also when you look at the scale of what the government would have to do, this is one of the reasons many in the Labour Party have been backtracking from what John McDonnell has said, is that there are a number of problem PFI contracts that would be better if it had been taken back into...
Exactly. There are specific contracts which are wrong. PFI is not going away. It'll get renamed, but that'll be because the government needs that funding. It can't do without it.
And if they were to confiscate those assets, we've got 200 billion of financing requirements for infrastructure. I mean, INPP is an example of one of these infrastructure companies is currently underway building the Thames Tideway. So if you were building that thinking the government was about to confiscate, I think you'd pretty much quickly shut down that project. So
It does bring up, the client does bring up a very good question there about, and concern one has to, from a multi-asset perspective, Corbyn risk. He's still maybe a few years out, but
it's an investment time frame.
But Prime Minister Corbyn, what is he going to do to your investment?
Well, a May risk. We've got a dysfunctional government.
But it's just on the Corbyn side, I think that what are his policies and whether he does dedicated policies, but to date it's going to be more spending. We know that. It's probably going to be higher taxes for the few rather than the masses. I would argue that none of this, probably high debt, well, actually not probably, most certainly high debt. None of this is therefore conducive to, I'd argue, UK 10-year gilts at 1.35, I think they are today. So for us, it's, when you're investing, yes, he is a few years out, but it's certainly a threat or a risk on the horizon that one needs to be thinking about and sort of managing your portfolio accordingly.
James,
sorry.
Are any political shocks capable of doing anything to the market these days? I've been hosting this show for a while now, and some of the time we've been on the day after maybe a Brexit vote or a Trump election, and the markets just seem to bounce it off.
Yeah,
so,
people have this expectation the UK equity market is the UK economy, and it's totally not the case. I mean, one of the stats we talk about in terms of the general retail sector, people worry about retail sector, the whole of the general retail sector in the UK, in the market, is only as big as Rio Tinto in the marketplace. So we can talk about the high street, the problems, consumer spending, the rise of the internet, but let's put it in perspective. The industrialisation of China and urbanisation of China is much more important for the equity market, as important for the equity market, as the UK consumer. So I think that's why we've been protected from a lot of this domestic policy. 70% of our revenues come from overseas. Sterling goes down, the value of those overseas earnings go up automatically. Things like Diageo, Glaxo are going to sell exactly the same amount of product tomorrow as they did yesterday. And they could equally be quoted in the US or Europe. They're just international, happen to be quoted in the UK market.
Our domestic political issues, frankly, as internationally, aren't that important. And they're not going to be reflected in our markets, really. And where they will be affected is in the price of sterling. Yeah. And that's where we have to, because we've gone from 150 on cable, went down to sub 120, and now we are back at 134 or something like that. That has a big impact on people's, particularly the end client, who's obviously they're in sterling. So we've got to be very careful as we're investing around the world. But longer term, sterling, I'm afraid, is going to be weaker.
But it's a great shock absorber for equity market. I mean, that's how we think about it. If there's shocks and if things are perceived to be going badly, sterling comes down, the value of those overseas earnings goes up, and the equity market goes up, which is exactly what we saw after the referendum. We had a few days, maybe a week of reflection and panic, perhaps. But by the end of the week, the equity market was higher. And that's a big support for the equity market. We've got to remember we are an international. We might be called UK, but it's a global equity market.
Yeah. You say sterling will be weaker. I think
on much longer term basis.
I agree that sterling definitely has challenges, but it is still a cheap currency. I actually did my master's dissertation on FX forecasting, and after 6 months of studying. After all this work, the conclusion was it's really hard. Most people get it wrong. So I just want to kind of understand why you think it will, in the longer term, be weaker from here.
Because the importance of the UK economy is generally weakening. It's not going to be as important as before. It's a small reserve currency and getting smaller. And so on that basis, I can't necessarily say what... If I was outside looking in towards it, it's not the one I'd be rushing towards. But we're inside here, so we have to manage that sterling risk.
It's quite a consensual call, though, isn't it? Everybody's saying sterling's going to go weaker. That kind of interests me. When everybody's positioned one way, thinking, and then we saw the rally in sterling.
Perfect. That's exactly the moment you actually then go and buy your options on the other side, and that's exactly what we've been doing, expecting sterling to be rallying, which it has been.
So we run global funds, so we're very much benefited from sterling depreciation, and then but obviously if it appreciates, it does impact our portfolios. But we don't actually try and hedge. We hedge our defensive assets always. So when we talk about US Treasuries, always fully hedged. but equities we don't, because it comes back to James's point. When you look at investing in a European company, it may be euro listed, but where is the earnings, where is revenue? So you're actually blindly trying to hedge currencies. I just think you're incurring more and more costs.
Without understanding what the underlying company's hedging policies
It
are.
is, exactly. So when you, if you do a historical study, you look at volatility, you look at the volatility of global equities in sterling, so non-hedged, and in hedged, and pretty much the same. And for us, it will wash through. And therefore, by trying to call it and potentially get it wrong, you just incur more and more costs.
So calling, what you're doing is effectively buying some insurance in particular areas. So, for instance, last year at the Brexit, what was the currency insurance you'd want to have? It wasn't on the fact we all knew what the vote was going to be. Ladbrokes told us we were staying in. The risk was on the other side, which of course no one was expecting to that extent, and so therefore your cover would have been having a sterling hedge on that, which would be a sensible thing to do.
I mean, the UK
and didn't cost very much.
The UK is a small part of the global economy, and this just provides more emphasis on why clients should have a globally diversified portfolio. I mean, that helps to reduce the political as well as the economic risk of one individual country. So I think, to think that we've got all the best companies in the world in the UK, I think is a bit of an oversight. I think it's much better to find the best mining company or the best pharmaceutical company on the planet, rather than looking at pharmaceutical companies versus oil companies in the UK.
But what you do find, because of this, volatility and worries about the UK, occasionally those global companies you do have in the UK do come down to quite interesting valuations when on a comparison. Personally, I think that's where we are now. You look at the UK on a sector-based valuation; it's cheaper than a lot of international markets.
I just want to take a brief moment to channel my inner Springsteen for a second and ask: is there anybody alive out there? The questions haven't been flooding, and I expect to see steam coming out of this generic fruit-based device in front of me. So don't make me come round and get some more questions out of you. Thank you.
Just picking up on James's point there, I think if you actually do some historical numbers, I think the UK hasn't been a top-performing region in the last 20 years. Never once. And I think the number of listed companies, I think UK represents 1% of the global listed companies. So I do think, and hence why we're global in our allocations, you are better off going globally and choosing the best mining company or the best tech company and having that opportunity set, the global opportunity set.
I have a good question here from David Jeffries, who wants to get specific again on the unwinding of QE. To what extent will this happen by default as assets reach maturity, or are central banks only sitting on long-dated assets?
Well, no, of course there's going to be some runoff, and that's a very sensible way of doing it. And actually not create the panic and just sort of say, keep quiet, chaps, just let it go. But the market will be watching very closely to actually see, is there anything else going on? And then, as it's running off, is that affecting any of the asset prices which were pushed up? And if there's any fear on that, that's when they'll stop.
Okay.
So I think the numbers, the Fed are about 4 trillion now, and I think they expect to be at 2.5 trillion in 3 years' time. Some of that will be running off, some of that will be selling. Okay.
We had a brief look at the UK equity market and the dynamics of the political situation there. Let's pop over to Heathrow, take a flight over to the States, and talk about. We haven't heard much about what's driving the US market or not driving the US market from your perspectives at the moment. What have you got your eyes on when it comes to the land of Trump?
Look at the main driver of the US economy, Mr. and Mrs. Joe Schmo, living in Little Rock, Arkansas, shopping in Walmart. Their primary asset, their house, has done very nicely in the past 10 years. You've got consumer confidence at a 12-year high. That's the primary issue driving it at the moment.
Right. Okay.
If you look at US consumer sentiment or small business consumer sentiment, US small business hiring intentions, they're all at 5-year highs. So, I mean, it is the small and medium businesses that drive the US economy. If these tax deductions do come through, I think that could create some growth. But as the point on politics, what it is that Jeremy Corbyn can do, we've seen that what Donald Trump has been able to do, and it's very little.
I mean, I do think one needs to be slightly careful though with soft indicators, because I mean, haven't been seeing the hard numbers coming through as much as the soft indicators would suggest in the US. So I think the US economy is doing okay, it's doing a trend, but it's not doing as well as one would have thought if one had been looking at the confidence numbers.
I mean, I don't know when GDP growth rates keep getting revised up, so I mean that's a positive That's a
But they're
revision
not
upwards.
agreed. But they may not be in line with the consumer confidence numbers that one would have expected to be looking at forecasts.
Yes, they don't necessarily go in line with one another, but I think this is a very nice position about it. It's growing steadily, and our outlook is actually that's probably likely to continue. The good news is Trump doesn't control the economy, and I'd rather have Janet Yellen there. And one of my concerns is what happens to her next February.
But in terms of driving the markets, do you think that one has to, what's a tax reform and or whatever we lack of, or if it does happen, and assume it will be scaled back, one does need to come back to the from an investor's perspective, the valuation aspect in the US, and thinks what is priced in a and we are probably from a regional perspective, whilst we like European equities, we are slightly more cautious on US equities. From a valuation perspective,
But they're probably a little bit further down the cycle.
They are.
Not end cycle. I wouldn't have thought
No.
in my own view, but they are further down the cycle. So if you're thinking about recycling that capital, perhaps Europe is.
That's the point you made earlier. It's the cycle, and that's the good bit, where it looks as though this is returning to a cycle. We're seeing a slow motion slowdown. It's still growing, but at a slower rate, and that's fine. That's exactly what we'd want to see now. So that if because the whole point of having QE was to actually try and see if we can get back to some form of cycle. It won't be as strong as it was before, but I think that's really rather positive. So the slowdown in 18 months' time is what Yellen will be looking towards, and that's when you can cut
There are
again.
some positive things to say. I mean, whilst we can look at headline numbers, we still find attractive places to invest in the US market. US residential houses or residential homes, single-family homes, are the most affordable houses in the developed world. When you look at mortgage applications, they're rising quite rapidly. Now, that's not leading into purchases of houses, but that's because there's a lack of housing availability at the lower end. So when we see those numbers, as well as obviously the significant fall in house ownership in the US, there is an argument to be made that will normalise and we'll get a higher house ownership, higher house building, that will lead to a positive part in the economy. But all of that is probably superseded in financial markets in terms of sentiment by what happens with quantitative easing and the unwind of the balance sheet.
and I think the tax plan, as you mentioned, and I think that is significant. I think that what are the numbers they're coming out with? I think it's projected to cost about $5 trillion, and I think most people suggest it will be sort of closer by the time it's revised. Maybe if it does go through 1.5. So you
got a long way to go, yeah.
It's got a long way, a lot of debate. We saw it with healthcare, and we'll see it with
It's the reality rather than
Exactly.
the plan for it. I think
James,
that's
you've got a fan club out there because somebody's asking which areas of the UK equity market does James like at the moment, and what is he avoiding?
It's a good question. I mean, we are very much stock pickers rather than sector pickers. That's what we really concentrate on. What our, how we think about the equity market is. It's a volatile world. Why? We've seen just the sterling recently, and consumer confidence continues to defy expectations. So we don't want to be making those big sectoral views at the moment. So we're very much at the stock level. So it's a question of whether you want to be in the regional house builder versus a London house builder. We're more in the regional house builders. That's how we think about the world. Where do you want to be in banks? We've talked about emerging markets. Do you want to be in Standard Chartered, or do you want to be in that little-known bank called Bank of Georgia, which is one of the fastest-growing economies in the world, Eastern European Georgia rather than US Georgia? So that's how we think about the world. So there's a lot of spread in the UK market. There is a lot of variability out there, so you can actually pick companies with lots of different dynamics and build a portfolio. It's about diversification. You talk about a global perspective, exactly the same in a portfolio. But within that, we're finding quite a lot of banks areas that are cheap. They're still trading well below the historic averages, and obviously with QE, with the interest rate rise environment, banks is an obvious area to be in. International areas are doing very well. Our manufacturing sector continues to grow.
So how do you just, when you think about the banking sector and historical valuations, obviously the returns on equity are likely to be lower going forward, so arguably they do deserve a lower
yeah, that's right. I mean, with a higher capitalisation, clearly that's going to reduce your return on equity, but if you look at relative to the book value, some of those companies are still trading at discounts to book, depending where you look. Some are still very early in that recovery phase. Think about Royal Bank of Scotland. I know the government overhang is an issue for some, but you look at that valuation, you look at the recent trading, they're starting to possibly turn that corner. So again, being slightly contrarian, looking for that value opportunity. Royal Bank of Scotland in the banking sector is an area that we we're looking at the moment. So yeah, you've got to be right. You've got to adapt to the current environment. But there are some companies out there which still look very cheap on that basis.
I've got another question coming here, anonymously again. Do multi-strategy funds have a place in a multi-asset portfolio?
Do you want me to take that one?
Discuss.
Because we have exposure to multi-strat with not uncorrelated, and yes, I think they do.
Okay.
I think when you do portfolio construction, the way we do it, we have our growth assets, where our equity sit, and our risky fixed income. You've got the defensives, the bonds we've been discussing quite extensively, and then you've got uncorrelated, where multi-strat sits. I think they all have roles, and it's come back to Justin's earlier point. I, in a plain vanilla multi-asset fund, don't own break-evens, inflation break-evens, because we don't use swaps. But in a multi-strat fund, an internal multi-strat fund, which is aligned in terms of your house view, does. So it's more sophisticated. It can play steepening curves in a more sophisticated
Can I take it back a few steps?
Of course.
What's a multi-strategy fund? Define one for me.
The way I would see a multi-strategy fund is in terms of, it's a bit like a multi-asset fund, but more sophisticated. In our case, it defines an outcome. It looks to target an outcome and saying, this is what we're looking to achieve for you and your investors. And then they have a tool set, which is similar to us, global and unconstrained, is wider. They can use derivatives. It's more absolute return in nature.
And is this a alternative to or a component part of a multi-asset strategy?
Very much a component for us. The way we use it, it's a component part. Some use it as an alternative too, but we use it as a component
To
part.
us, it is a multi-asset fund.
Right.
That's what we would do.
Right.
And it's developed from 15 years ago when it was a simpler version, and we've just been adding more tools as we've been able to do them as they've been developed. If they have a place in there. You go back 15 years ago, were there any derivatives in there for any particular purpose? No, there weren't. Now you can, and the rules allow us to do so. The expertise in the market has now changed, and we've now got a greater choice of facilities you can use. So why wouldn't you bring them in? That's always been our view.
And obviously with 7IM, you've been proponents of smart beta for a while. What are the other guys seeing in terms of smart beta movement in the marketplace? Is this finally growing to some sort of maturity?
It's a great bullshit bingo term, isn't it?
It is.
So for me, it's a marketing term.
Yeah.
That's why I was smiling when you were asking the question. Yeah, I see it as a marketing term.
I mean, it's a different
it's a way of
type of
selling.
index. That's all.
Yep.
So you can just look at an index in a different way and get a different result out of it. If you call it smart beta, it doesn't really matter. It's just another way of actually trying to play those.
For us, I mean, the proliferation of names and names for calling different funds and jargon in the financial industry. We like to keep it simple and transparent. We invest in companies and securities that have attractive valuations that we will believe will provide us attractive returns. And that will always change to different parts of the market. Sometimes it's growth assets, sometimes it's value assets, sometimes it's bonds, sometimes it's equities, sometimes it's alternatives. It's always about trying to keep it down to the base level. What are we trying to do for clients? Increase the real wealth.
But you make a point there, because some clients actually want a growth strip or a value strip or an income strip. And so we've seen that type of investment in bonds, and we're now seeing that in, arguably it's called smart beta or style investing or whatever.
We've always had growth funds and value
But now
funds.
but there's often style drift. You think about some of the classic value investors in the UK in the late 1990s, as the pressure came on, their value bias was taken away from them. So now you're getting these very possibly mechanical funds, but very, they do what they say on the tin. And so that's, I think, offering clients another tool in their toolkit.
Clients actually understand. There are now more indices out there than securities to select. Do clients actually understand all of these different tools that they've been provided with, given all the marketing jargon that goes with it?
Well, I think, sorry, just wanted to add one point about what they do, what they say in the tin. My concern is they don't. I think you've seen the development of things called low vol or min vol ETFs and things like that.
Backtesting, quantitative processes.
And my concern very much is that they don't do what they said in the tin. So they do it now, and they may have done through their back testing, but will they do it going forward? Will people be buying something thinking that it is low risk or low volatility at least, and suddenly it turns into something which they don't expect? And then how do they react? How do those investors react in that market conditions? Well, and what does that then? What does that then do to our portfolios? Because if you've got a forced seller, because of liquidity maybe or whatever, in the market, how does that impact your prices and your securities, maybe in the companies you like?
Yeah, but you're always going to have to stress test these these models, and you know, the people who, you know, are building them. You know, JP Morgan's got a team doing this now. It's very successful in the US. I mean, you know, if you do it properly, if you researched it properly, you know, they can add value to end clients. But
some of
I think
these
you're right.
things
You
can
do
be
need to see some stress testing. Some clients will need to see
some
them
of
go
these
through a
things can be
cycle.
straightforward, like ETFs. Okay, ETFs now been around a long time. It took a long time to come into the retail side. They were really very cost-effective ways of doing it.
Yeah.
It wasn't helped when the stock exchange tried to launch it. The stock exchange can't launch anything really, but they have provided very cost-effective ways of being able to enter a market if you don't have the expertise and knowledge and time to actually go down to stock level.
But I agree and I disagree. So I agree that ETFs certainly have a role within the portfolio, but it really depends upon the index that they're tracking. And a bit of homework for people watching. If you go and look at we talk about emerging market small cap, look at how well or how badly the emerging market small cap ETF has tracked the index. So they'll see the name emerging market small cap ETF and they'll think, oh great, it'll give me exposure to this market, but it does a really bad job.
Yeah.
Conversely,
Because then you need to know what's in it. Is it dominated by China or Russia, or whatever it happened to be?
And conversely, S&P ETFs, fantastic. They do a great job. So when you're as an investor, you need to really differentiate between these solutions. So I do think they're very
But
important.
that in many ways is why, as multi-asset, multi-strategy fund managers, that's what we're there to do.
Exactly.
If someone's building their own portfolio, quite rightly, they need to look inside and understand it, because these things do vary hugely. But as multi-asset managers, therefore, we're going to be adopting some of these things on the basis that they won't necessarily have all the knowledge on it, because they expect us to have done the homework.
And
and
this is
tested
the
it.
investment
On that
selection.
vein, moving away from the index side of things to the experts who should know what they're doing. Got a great panel here, a question here from Guy Shepherd. Guy, very cheeky. Does the panel think that Neil Woodford is ahead of the market, knows something we don't, or is misguided?
There was a classic example the other day, wasn't it, with Provident Financial, when you just see how difficult it is when you're picking stocks and you find yourself a significant player in those stocks. You are the market. And that's always been a problem if you're, ever since I've been involved in the market, you find yourself in a position where you are holding too large an element. So if you're buying it, you're pushing it up, and then you find you actually can't sell it.
So it comes back to this liquidity point. I mean, I think Neil is a fantastic fund manager, and I would never suggest anything negative towards him. But I do think one needs to be conscious, as Justin says, of how much of anything you own. And can you get out should you want to?
There was a
Very
time we had-
concentrated portfolios he has, and then that's his style. It's worked over a long time. But you know, 1999, you know, when he was at Invesco, you know, the rumours has it he was, you know, one of those value managers came under pressure, and obviously the tech bubble burst in time to say, you know, to save those funds. But you know, it's his style. You know what you're going to get. It's going to be concentrated. It will be volatile. But with liquidity an issue and the positions he has, you probably do want to have something on the other side to diversify that stock-specific risk.
And Chris Redfern's asking, what are your views on growth in passive investing, given the current high valuation on equity and bond markets?
I quite like. Well, conversely, if more people buy passive, there's more dumb buyers out there. So that should hopefully create space for the active manager. If you're just buying, you know, the index come what may, no matter if it's on 50 times, 60 times, fine. You know, if that keeps growing, it creates space for the true active manager.
But you see, there's nothing. I find it rather fatuous, this active-passive argument the entire time, because they're really good active managers. Passives also have a role, but also you actively use passives because it's another trading block item you're using, and that you could build portfolios partially that way. The result of it is that you end up with a blend. You're going to end up with stocks, you're going to end up with baskets, you'll have ETFs, and you may have some derivatives in there providing some insurance.
And similar to Justin, we take a blended approach, and I think that's, to be honest, I think that's the best way. Being selective, doing the investment selection, saying, actually, in this market, I think you can outperform as an active manager, EM small cap. But in US equities, it's really, really hard. I mean, it's not just a short time, it's a long time horizons of where it is very, very hard to outperform as an active manager after fees. So we passively track it.
Okay, and to wrap up, get your crystal balls out, please, onto the table, and delve deep into them. If we were having this conversation 12 months from now, what would be the things we're looking back on? What is it that you've got your eye on very firmly in that in the medium term?
Well, in the hope that we haven't actually had thermonuclear war in the meantime. I'd say I found it's the first time, I think, in my career, actually, in the sort of weekly notes, actually writing that, thinking, don't be so stupid. So let's assume that doesn't happen. The global economy finds itself in a rather good place. And so let's assume also that central bankers aren't going to be dumb and not going to sort of start acting irresponsibly. That actually, I think the global economy, with a reasonable oil price at the moment, finds itself in a quite reasonable position. So where would I want to be? The answer is probably with more equity exposure than fixed interest exposure. And there's also some interesting commodity recovery as well. So I'm really positive over the next year.
Tom?
Similar to Justin, I do think things are looking pretty favourable from an economic perspective. I do think as a fund manager we have to work harder. So you have to choose your value regions, but I do believe that places like Europe and emerging markets will be rewarding for an investor.
Paul?
Yeah, I mean, I'd suggest stay away from bond markets whilst some of this QE unwinds. You're certainly not getting paid for any of the risk, and there's not really much upside in the fixed income markets, especially investment grade and government bonds. And so I would favour other areas of the market. Emerging markets look interesting, and some of the, I guess, alternative assets that we look at that have that inflation-linked protection, but also with much higher returns than what we find in bond markets.
And what are you going out to buy, James, today?
Well, we're quite constructive, globally and in the UK. I mean, obviously there's a risk about the UK, so we're pro-risk, in asset allocation within our portfolios. We can see opportunities in the cyclical sectors. The banks we've talked about earlier on. Look around the global economy, it looks pretty good. So why not be more cyclical, higher risk within your equity selection as well? That's in the UK with that international outlook. That seems a very appropriate place to be. A year's time, hopefully, we've made some progress on Brexit. Hopefully we can be looking forward rather than looking backwards.
Great. Gents, we could do that all day, but sadly time has caught up with us as it always does. We will be back here in about 5 minutes' time to talk all things income. We're going to delve into where yield is being found. I'm going to go and swap out these fund managers and bring a whole fresh team in. You stay exactly right there and I'll see you in 5 minutes. Thank you very much.